Boy, that escalated quickly. I mean, that really got out of hand fast.
Hello, I'm Chuck Biggs with Epic Lending, and I want to take a moment today to talk about something that's been in the news, and that's loan level pricing adjustments and how that is affecting Fannie Mae and Freddie Mac loans. Pricing adjustments have always been around in every product for that matter, based on LTVs, down payment, credit scores, etc. But this is a little bit different in that they're using factors to help give a little bit better pricing to folks that fall in the lower thresholds of credit scores and folks in the higher kind of paying for it. But this is how it works. Let me give you an example here. What we're going to do is we're going to base this on a $500,000 purchase price, a $475,000 loan amount, which is 5% down. And we're going to look how that would compare today, everything else remaining the same if the changes had not been made. So today's pricing with those changes on a 740 borrower is a 6.5% interest rate. That rate's going to cost them $3,788, just a little over 0.75%. And that would give them a payment of about $3,002. If those fact changes had not gone into place, the rate would have still been 6.5%, but the cost would have been a little bit less. It would have been $1,957 on this loan size. So you can see the difference there. It's a difference of what, about $1,800. That same scenario, but with a 660 credit score buyer, okay? How does that affect? Well, today they'd be looking at a 7.25% rate. It would cost them a little over 0.5%, about $2,600 to be exact. And that payment would be $3,240 a month. If these changes had not gone into effect, this same borrower would then have been paying 7.5%, okay? The cost would have been almost $1,000, $978 for that loan and for that payment and loan amount. But that payment would have been $33.21. So basically, $80 more than what they're paying today. So how does that work out? Well, it does help the 660 FICO client, does not help the 740 FICO client. But the reality is this client could do much better going FHA. So in the end, is this really going to help anyone? Because it looks like in most cases, our client here is going to go FHA, where I could get them a very similar rate to this, actually probably less cost, lower MI, etc. So I hope this helps clear a few things up. Definitely, it's not worth it to trash your credit to try and get a better rate, because you're not going to get a better rate. You're just getting a little bit less tough of a rate in these scores because of these new changes. So call me if you have any questions. I can be reached at 480-258-2281. Thank you.